So if you bought the Fed rate cut, thinking, oh boy, game's on, you bought the top. It's building a base, which you can't quite see it on the price chart, but on weekly momentum, I can see a clear ceiling that's been built. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to 40 bucks or 41 or whatever, and I don't see it.
In today's news recap, silver's been included in the U.S. critical minerals list. The U.S. Department of the Interior released a list of critical minerals, adding materials such as copper, silver, and metallurgical coal to the list, thereby increasing the risk that these materials may be included in future tariff policies. The market had anticipated the inclusion of copper and coal in the critical minerals list to some extent, but the inclusion of silver has sparked widespread concern. If tariffs are imposed on silver, its liquidity could face issues again, potentially causing significant volatility in silver prices. Suki Cooper, an analyst at Standard Chartered, stated that it remains unclear whether the U.S. will impose tariffs on silver, but listing silver is the first step in this process. On the other hand, the U.S. has included certain customs codes for silver in the tariff exemption list, which may mean that specific types of silver will not be affected by tariffs. Approximately 2/3 of silver supply relies on imports, while it is one of the key materials for electronics, solar panels, and electric vehicles. The inclusion of silver on the U.S. critical minerals list will further highlight its status as a strategic mineral, potentially signaling a paradigm shift in the supply and demand dynamics of silver and ultimately its market price. Previously, due to concerns about potential tariffs on silver, large volumes of silver were preemptively transported from international markets to New York warehouses, causing a liquidity squeeze in the London silver market. This became a key factor driving silver prices to record highs in early October. As supply in the London market has increased, silver prices have consolidated over the past few weeks. However, if tariffs prompt another wave of large-scale movements, silver prices will experience significant volatility once again. In addition, silver mining companies with extensive operations in the United States and its partner countries are poised to become the primary beneficiaries of this list. Beyond the impact of tariffs, these firms will also benefit from U.S. fiscal incentives, production subsidies, and streamlined approval processes for new projects, further reducing their operational costs and enhancing profitability. Some of the froth has been blown off in a much-needed correction, Rona O'Connell, an analyst at StoneX, said in a note. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I can see a clear ceiling that's been built. Such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to 40 bucks or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, you know. The surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, so again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued and investors just say, phooey with that market. It's, it's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say, look at the silver gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at.
In today's news headlines, bulls target $49 silver price as demand and dollar shift. Silver is trading near $47.79, climbing steadily after rebounding from its ascending trendline support around $46.91. A level that has consistently attracted dip buyers since late September. The metal's technical setup and improving macro backdrop suggests that momentum could soon tilt in favor of the bulls. From a fundamental perspective, silver's rebound coincides with easing U.S. dollar strength and growing optimism about a recovery in industrial demand. The U.S. dollar index has retreated slightly from its 3-month highs after recent Federal Reserve comments hinted at a cautious approach to further rate cuts. Markets now price a 65% chance of another cut in December, down from 90% last week, signaling mixed expectations that are keeping precious metals in play. At the same time, industrial consumption, which accounts for over 50% of global silver use, continues to strengthen. Rising demand from solar energy, electric vehicles, and semiconductor manufacturing has reinforced silver's role as both a safe haven asset and a key industrial metal. Meanwhile, ongoing concerns over a potential U.S. government shutdown and slowing global growth have boosted safe haven interest. Investors are positioning silver as a dual hedge against both market volatility and the dollar's pullback. Some of the froth has been blown off in a much-needed correction, Rona O'Connell, an analyst at StoneX, said in a note. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Well, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since, I actually go back 11 years now, about from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. This now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of DC gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Bigger numbers below the S&P, percent or so below today's low, and on the NASDAQ that would say, uh-oh, you're probably headed down. Now, not disastrously. We think what's been going on in the U.S. stock market since late last year, in fact, is a topping process. We made our high in January, February for the NASDAQ 100, S&P. We had the headline sell-off, which you don't like. If you're a bear, you don't need a headline. You'll get them later. You know, this bank fails, this company fails. You don't want to hear it at the beginning. So we heard this tariff stuff suddenly became the be-all and end-all of the world. Now it looks like the Supreme Court might sort of push some of that aside, in which case that's not even an issue anymore. Well, let's get it out of the way, because frankly, the reason the stock market would top is not because of some headline, which Trump, of course, tried to solve by saying, oh, I'll give a 90-day delay. And so we had a rally off the April low. But making the new high, for example, in the S&P above the January high, we got another 10% or so above the January high. And now we're slipping off some. We think it's all part of the topping process. The same thing happened in 2000 and in 2007 when the S&P was topping. It made a high, looked negative enough for us to say, get out of this category, dropped, but then came back and made a new high, which was a teaser. Whereas if you succumb to the new high and thought, oh my, the game's on again. No, you were wrong. It was a trap. And in fact, the one in 2007 that made the new high was in October 2007, a few weeks after the Fed, surprise rate cut. So if you bought the Fed rate cut, thinking, oh boy, game's on, you bought the top.
What do you think of Oliver's take? Do you agree with him? Is this correction just a base formation before gold and silver move to higher highs? Or have we witnessed the top already and nobody knows if the price is going to sink like a stone? Post in the comment section down below if you're a true stacker and share with the community your stacking plans moving forward. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.